A recent study analyzed where Canada stands in comparison with other G7 nations when it comes to housing affordability, housing prices, and indebtedness. In this video, we'll take a look at 5 charts that shows how Canada has taken on more mortgage debt than any other G7 nation. Stick around. Welcome back and thanks for tuning in. My name is Andrei with the Medow Group, and we service Ottawa and surrounding areas, all things real estate. If you're new to the channel, please consider subscribing and hitting that bell notification for upcoming content. And if after this video you might have some questions and would like to schedule a quick call to talk more, there's a link in the description below. So the cost of borrowing money is getting more expensive for consumers looking to take on a mortgage. We've had tons of interest rate spikes throughout the year and another one possibly coming before the year end. But Canada might be facing more challenges than you think. A recent study done by the Organization for Economic Cooperation and Development, aka OECD, analyzed Canada in comparison to its G7 peers. Now you need to understand that high interest rates eventually increase the cost of everything, so mortgages, credit cards, and loans. And the idea behind the interest rate spikes is to discourage consumers from spending money. And to this, the Bank of Canada raised the rates from just 0.25% in January to 3.75% last month. Here we're looking at Bank of Canada's interest rate versus inflation rate versus mortgage rates. So the current overnight rate is 3.75%, and the current mortgage rate for a 5-year conventional mortgage loan is 6.49%. The most recent inflation rate of 6.9% is for September of 2022. The gray line here is the start of the pandemic. So inflation was at about minus 0.2. It started to climb up, went up to 1% in November of 2020, then up to 3.6 in May of 2021, started to go up, and we actually hit our peak in June, which was at 8.1%. And as of October of 2022, it is now sitting at 6.9%. Now the policy rate was at its lowest, which was 0.25%, and it started to increase in February of this year. So it went up to 1%, then it went up to 1.5, 2.5, to 3.25, and it's now at 3.75 as of October of last month. The mortgage rate for a 5-year conventional was at 5% at the start of the pandemic, dipped down to about 4.79, and it started to increase in May of this year, and we are now at 6.49 as of October of 2022. When compared to other G7 nations, Canada actually has the most expensive housing market. The price to income ratio, also known as the measure of affordability, was still the highest for Canada, followed by Germany. According to the data, Canada's ratio index reached 148.16 in the second quarter of 2022. That means housing prices grew at a rate of 48% faster than income since 2015. This is the measure of affordability. So this graph looks at quarterly data. The most recent is Q2 of 2022. The price to income ratio is the nominal house price index divided by the nominal disposable income per person, and this is considered as the measure of affordability. So as you can see, it kind of goes back and forth between Canada and Germany, and the final numbers as of Q2 of 2022 is giving Canada 148.2. Something interesting that the Deputy Governor with Bank of Canada said in a conference earlier this year was that Canadian households that have taken out mortgages with high loan-to-income ratios probably aren't the ones who have a lot of cash in their bank accounts. And this simply means that a lot of consumers don't have access to disposable income as it's tied up everywhere else. What happened at the start of the pandemic was that the super low interest rates actually attracted many Canadians to buy homes, work remotely, take advantage of homes in the suburbs that were much cheaper, and because the consumers had access to much more disposable income, well, the demand literally surged to quickly get a home mortgage. This is a very interesting graph, mortgage loans versus non-mortgage loans in Canada. The numbers are in millions. We'll start with non-mortgage loans. So back in 2000, we had $238 billion, and fast forward to August of 2022, we're at $724 billion. Here's the interesting part. So the mortgage loans back in August of 2000 was about $418 billion. And if you can believe it or not, as of today, we're sitting at $2 trillion in mortgage loans as of August of 2022. Fast forward to today in the current high interest rate environment, the higher rates have actually contributed to a sharp decline in housing interest and home prices. On average, home prices in Canada have fallen by 22% in the span of just 7 months. And don't forget that affordability includes high rates and inflation, which can really stretch the consumer's expenditure and, in result, not be able to qualify for a mortgage. But despite the cooling market we've seen this year, Canada still has the highest nominal housing price, and according to OECD, the ratio index for Canada grew by 59% since 2015, which is the highest jump by any G7 nation. Here we have the nominal house price indices. So this is the house price index, which covers the sales of newly built and existing dwellings. And as you can see, again, Canada and Germany kind of competing against each other. And in the end, it looks like Canada is sitting at 183.9, and the lowest would be Italy at 107.3. In 2021, household debt in Canada was 185% of disposable income. And due to the soaring housing prices during the pandemic, Canadians took on more mortgage debt in order to pay for a home. High indebtedness among Canadians could amplify the impact of interest rates, and the concern is that a lot of the current mortgages are variable rates and they will eventually fluctuate with the bank's policy rates. Household debt, so how Canada compares to its G7 peers, percent of net disposable income, 2021, or the most latest available data. So Canada is the red thick line. It was actually 1 point back in 95 lower than Japan, but as you can see, it started to rise in 2019, and then it kept going up and up. And as of today, or the most recent data for 2021, we're sitting at 185.41. And then if we go down to the lowest, it would be Italy at 90.92. What do you think? Will Bank of Canada continue its trajectory of raising interest rates again this month and maybe even in the start of 2023? Has inflation come down enough for Bank of Canada to ease off at least for a quarter or two? But the biggest question remains today: will Canada ever even have affordable housing? Thanks for watching. Catch you in the next one.